Friends, in this video for ithought Advisor, I am going to talk to you on the topic interest rates and the expectation reset. Interest rates have just started moving up. We have some distance to go and it's time for us to decide what our return expectations must be in the future. A lot of you are familiar that the Indian investor chooses to move from debt to equity when returns in debt become very unattractive. So, when debt returns are plummeting, people shift their capital from debt to equity as an asset class. Similarly, when equity returns look very bad, they shift from equity to debt just to safeguard their capital and get a reasonable return. It's not always the case that you must shift in bad times. In my opinion, starting to move out of an asset class must happen in the best of times. It should not wait for times to get worse. Therefore, the case for a reset in investment expectations happens when one asset class, say debt, is doing very ordinarily and equity is doing extremely well. You will agree that that case has been before us for some time now. It's time for us to think where we should allocate our capital, how we should prepare ourselves to build some component of debt in our overall portfolio, to think how best this should be done, and to progressively move towards scaling up debt investments over a period of time and improving our expectations on the debt side. At the same time, we need to moderate our expectations on the equity side. So, if we had exceptionally good years in recent times because interest rates were coming down continuously, we need to understand that that phase is probably behind us. And going forward, we will have times when equity returns will moderate, equity valuations will moderate, and expectations have to follow this. So, one should take the initiative to moderate expectations from equity, set more realistic return expectations, and gradually up our expectations in debt. As our expectations keep rising, we should allocate adequate capital to debt and build a debt portfolio as rates keep rising again and again. At some point, you will get the feeling that rates have done their full course. By that time, you should have built a debt portfolio which will deliver superior returns going forward when interest rates begin to fall again. So, this cycle is waiting to be played by each and every one of you. You must play the cycle right in equity and in debt, and moving from one asset to another is dependent on your ability to adapt to the cycle in each asset class. It's important for you to understand that the time to prepare for that shift has begun and you should dedicate your mind space to accomplish this comfortably in the coming quarters. Thank you for watching this video.